So the tariff to and fro continues. U.S. President Donald Trump getting a setback in the Supreme Court last week, but vowing to go ahead with a 15% levy on imports into the United States on many of the country's global trade partners. Let's get more now from Nate Thooft. He is Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks very much. You reckon that really the tariff story has exhausted itself with investors. And anyway, a lot of the impact is now behind us.
Yeah, I think that's fair, Andrew. It's great to be here. From our perspective, there's two reasons why the market is kind of looking at this and saying, oh, well, we're not seeing a lot of major downside. We're not seeing a lot of major upside. But there's two reasons for that. One is the fact that the markets are a bit exhausted from the topic. This has been going on for well over a year at this stage, and it's just a constant battle, right? But the second and probably the most important aspect of it is the tariff levels that we're seeing are actually lower than the peak levels that they were talked about at some point in time during the course of last year. And even with the recent Supreme Court announcement and the possibility of renegotiating or implementing the additional 15%, the tariff level that will actually be priced into the market is lower than what we came into the year. And so we are looking at an environment where, generally speaking, the worst of the pricing of tariffs happened last year and is unlikely to be the case this year. And I think that's what the market is looking through to say, hey, we've seen the worst case scenario. We're not revisiting those high levels of ultimate tariff levels.
Nvidia, you think, will be a bigger deal when it reports on Wednesday?
I think earnings is probably the biggest story of the week, to be honest with you. There's a number of earnings reports. Nvidia, in particular, obviously the biggest company in the world, representing in the neighborhood of 5% of the global equity market, is a massive indicator of what the CapEx cycle looks for, like AI. And expectations are really high. We're talking about 70+% earnings growth year over year. That's a big number. So they have lofty expectations. But let's keep in mind, Nvidia has a history of beating those expectations, and their outlook will be very key as it pertains to, can they keep that earnings growth and that level of earnings growth over the coming 12 months?
Let's pop up TLT, a US ETF that tracks longer-term bonds. You say around the world we are seeing investors more reluctant to hold longer-term government debt?
Yeah, I think there's a challenge with the fixed income markets in general. We have an environment where we know central banks are going to be accommodative, and we're likely to see more accommodation by things like the Fed lowering rates at a couple quarter points this year. We have other central banks lowering rates, but that really only impacts the short end of the yield curve, as in bonds that are due over the next couple of years. But when you look at the longer end of the yield curve, there's greater concerns about longer run inflation levels. There's greater concerns about fiscal spending and debt levels. And so we do think there's going to be a steepening of the yield curve, which means the longer end of the yield curve doesn't come down as much as the short end of the yield curve. And from our perspective, this means investors should generally focus their fixed income portfolio on the shorter end of the yield curve, particularly what we call the belly and inward, kind of the middle of the yield curve to the shorter end, without going out too far to get to longer duration fixed income assets.
Essentially, just turning to stocks broadly, you see steady U.S. profit growth as supporting the equity markets?
This is the biggest tailwind in the markets right now. We still believe this year will publish, despite all the geopolitical risks. And let's be honest, there's no shortage of them. We have the Iran situation, we have tariffs, we have other geopolitical dynamics throughout the globe. But when you look at underlying earnings potential this year, we are very likely to see earnings growth in excess of 10% year over year in most geographies across the globe. And this includes geographies that haven't done as well from an earnings perspective over the last, let's say, 5 or so years, such as the emerging markets, which could easily potentially publish earnings growth of 15 to 20% year-over-year growth from an underlying emerging markets index perspective. So we're seeing a pretty broad array of both countries, sectors, and companies participating in upside when it comes to earnings growth in 2026. And that is the biggest potential tailwind to overall equity markets for the remainder of this year.
How are you guys, you and your colleagues, handling energy right now, in particular oil and gas?
This is the one area of the geopolitical dynamics that we do have some concern about. And what do I mean by that. Generally speaking, when you have these geopolitical dynamics happening, markets look through them pretty quickly and say, hey, this doesn't really impact the markets overall too much. But when you have something like Iran and you have a situation where oil and the impact of supply of oil can be impacted, that's a bit more problematic. And right now we're starting to price in some what we call risk premium into the oil markets, which is the rise you've seen over the last month or so. But there is a potential, particularly if supply is cut off further, oil prices could go up even more. And that's a risk we have to think through, particularly as it pertains what's that flow through to overall inflation levels and what's that flow through to sentiment for the broader equity market. So that's the one area, in addition to the broader metals complex, precious metals, that we believe are the two focal areas for geopolitical risk this year.
Meaning that you're overweighting them, or?
We like them a little bit more than we did. And in particular, if you look at the metal side of things, gold and silver, we still like that trade. We think that geopolitical uncertainty puts a bit of a floor on and potential upside pressure on things like gold and silver, as an example. When it comes to oil, we think it's a shorter term phenomenon. We could get a repricing, let's say another $10 potentially, if we continue to see uncertainty, particularly around Iran and the oil supply. And that could provide upside for both energy commodities as well as the stocks that traffic in that area. And so in the short term, we like energy stocks, and in the longer term bias, we like gold and silver related assets.
And sorry, we've only about a minute. Why are you still fairly optimistic about gold prices? I mean, do you see them going higher from here?
We actually do, believe it or not. I think there's a couple drivers behind that. When we look at the pillars that drive gold prices, everything from inflation uncertainty, geopolitical concerns, debasement of fiat currencies, things like that, those are all still flashing green in our view. So generally speaking, the drivers that have driven gold to the levels that we're already at, they're continuing to be in place. And so we do believe there's still a lot of technical and sentiment and even fundamental drivers that could continue to keep a very strong bid under the price of gold throughout 2026 and beyond potentially.
Nate, thanks very much indeed.
Thank you.
Nate Thooft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management.